Most beginners assume businesses run on products. You make something, you sell it, and you survive. But look closely. Many businesses actually run entirely on timing. The timing of when inventory moves out and when the money comes in. Imagine you operate a lemonade stand. You buy your lemons today, you sell your lemonade tomorrow, but your customers promise to pay you next week. Meanwhile, you still need to buy more lemons to stay open tomorrow. Even though your sales ledger shows a clear profit, your actual pockets are empty. You are paralyzed because the money is missing. This same illusion traps real publicly traded companies. A business can report explosive revenue growth while its cash flow bleeds out behind the scenes. To expose this gap between paper profits and real liquidity, professional investors use a forensic metric. They study the cash conversion cycle, or CCC. A high profit margin means nothing if the money moves too slowly to fund operations. The cash conversion cycle measures exactly how long cash stays trapped inside a business before returning as usable money, giving you a direct timeline of a company's survivability. To see how this works in practice, let's look at two hypothetical competitors, Company A and Company B. Both generate identical revenue. Both have the exact same costs, but underneath, they are running on completely different internal engines. This equation shows how we determine the winner. The cash conversion cycle combines three working capital metrics: inventory days plus receivable days minus payable days. We start with the physical weight of the business, inventory days. This tells us exactly how long products sit in a warehouse before someone finally buys them. Company A moves its goods efficiently. Its inventory sits for an average of 73 days. Company B, however, takes a sluggish 182 days to clear its warehouse. Novice investors often see Company B's swelling inventory and mistake it for preparation for rapid growth. But an expanding warehouse usually signals something entirely different: slowing demand. Products are simply not selling as expected. Because it requires upfront capital to build those products, unsold goods act like locked vaults of trapped cash. Before Company B even records a single sale, it is operating at a severe structural disadvantage. Next, we factor in Receivable Days, which measures how long customers take to pay. This timeline shows Company A collecting its cash in 30 days. Company B waits 122 days. This creates a massive blind spot in standard financial statements. Accounting rules allow a business to record a profit the exact moment a sale occurs, but for Company B, the actual spendable cash will not arrive for another 4 months. To survive this wait, companies use one defensive mechanism: Payable Days. By delaying payments to their own suppliers, they buy time. This acts as a deduction, buffering the company against those long inventory and receivable delays. When we calculate the final scores, the difference is staggering. Company A completes its cycle in 48 days. Company B takes 260 days. Think about what that number means. For 260 days, Company B's operational cash is entirely missing. To keep the lights on and maintain normal operations, they must desperately search for external funding to bridge that gap. So how does a business survive an 8-month cash drought without collapsing? It relies on debt. When borrowing costs are low, companies can easily access cheap loans. This capital acts as camouflage, completely hiding wildly inefficient operational cycles from casual observers. But when economic conditions shift, when interest rates rise and overall liquidity tightens, funding a 260-day gap becomes incredibly expensive. This previously hidden operational weakness suddenly becomes fatal. Curious tone. Now, consider the extreme opposite of this vulnerability. Certain elite retail businesses manage to operate with a negative cash conversion cycle. Look at this timeline to see how that works. The retailer sells a product and collects cash from the customer today, but they negotiate terms that allow them to wait 60 days before paying their supplier for that exact same product. This means the business receives its money long before it has to pay its expenses. A negative cycle allows the company to be entirely funded by its own suppliers, granting it enormous, stress-free financial flexibility. This dynamic explains why professional investors evaluate companies differently. You can have two companies reporting the exact same profit margins, but the business that converts those profits into cash quickly will command much higher market valuations. Fast cash conversion lowers a company's overall risk profile. It eliminates the need for expensive borrowing and provides the immediate capital required to aggressively invest while competitors struggle during economic downturns. Conversely, a business with weak cash conversion might look incredibly cheap on paper based on earnings, but that low price reflects the high liquidity risk waiting quietly in its future. In the end, accounting profits are only an abstraction. The cash conversion cycle strips away that abstraction to answer the defining question of business survival. How long can this company operate before it runs out of its own cash?